I met Ross and signed a dotted line. I gave my mama 10,000 at least 1,000 times. Do the math on it. They want to see me fall, and I will never sell my soul.
What's Gucci, fam? Yeah, man, so we're back once again, guys, with another video, with another banger, guys. Yeah, we're back to work. So, guys, today we're talking about forex. What is forex? We're explaining forex in the simplest way that a beginner would understand. A lot of you guys have been requesting this. Let's get into it, man. Let's get into it. So, guys, we're gonna start off by describing the candlesticks. What is a candlestick? What is a bearish candlestick? What is a bullish candlestick? How do these candlesticks operate? Candlesticks are basically, they are like, how can I say, they represent price. I don't know how to explain them like into what they are, but they represent price. So as you can see right here, we have the green candlestick, which represents price going up, and then we have the red candlestick representing price going down. So these candlesticks, they have their opens, their closes, their highs and their lows, but how do you identify them? So you see these black lines here at the end of each candlestick. Those are called wicks. So this is the highest point the candlestick has been since it opened. It comes till here, and then it goes down here also. So this is the lowest it has been, this is the highest price has been. This is the close of the candlestick, so which means the candlestick closes here and then another candlestick opens here. So that's basically simple. And then when we come to the bearish candlestick, there's just some few adjustments here. The bearish candlestick doesn't open here, it opens here. It closes below, because obviously it's a bearish candlestick. So after the candlestick closes below, that's when you'll identify that it closed as a bearish candlestick. This is the high and this is the low. So these things, they never change. When it comes to these candlesticks, the highs and the lows, they don't change. So let's go to the next, guys. So guys, now we're going to be talking about leverage. What is leverage? Leverage is the use of debt in investing. So let me say you only have 500 rands in your account and you want to be able to trade NAS 100. Like you want to damage NAS 100. You want to add some lot sizes. That's where leverage comes in, where you choose to have a leverage of 1:500, 1:200. Leverage is basically there to help you trade a specific currency or specific index with your small amount of money, but like it helps you trade. A currency pair, some currency pairs cannot be traded with, let's say, 500 rands with a standard lot. So once you take a leverage of 1:2000, and then okay, now you can take a standard lot, but then the risk also increases just as like the reward increases. But leverage is just there to help you take specific trades with specific lot sizes. Leverage can magnify gains and losses. So gains means that the reward, it can, like, they can magnify rewards, but at the same time they can also magnify your losses. Your losses can be also severe, just like your gains. Leverage trading is buying and selling of assets with borrowed capital or debt. That's what I explained now. You only have 500 rands in your account. You take a 1:2000 leverage, which means that the broker is gonna borrow you some money in order for you to open certain lot sizes to make such amount of money. You see how people flip accounts from 500 to 10,000, from 10,000 to 100k. It's all about leveraging. But now if you over leverage the account, you might just lose a lot of money. So guys, what is the difference between leverage and margin? Okay, so in other words, leverage is the increased power to buy or sell financial instruments. We already explained that. Margin, in turn, is the amount of money a trader has to put up and maintain to keep a position open. So guys, this thing, it's all about funding the right amount. If when you are funding 300 and to open a trade on Nasdaq it's 500, you cannot open the trade because it says you need to have minimum 501 rands, let's say, to open an account, to open sorry guys, to open a trade on Nasdaq. So if you only have 350, this is where leverage comes in. Now this is where leverage steps forward. This is where you take a bigger leverage, like 1 is to 1000, 1 is to 2000, or let's say 1 is to 500, depending on now how comfortable you are with losing that money, or like how comfortable you are with making a lot of money. You see, it's all about risk to reward. So after you have planned your leverage, you can open a trade on Nasdaq with 350 if your leverage is very high, you see. But then your losses can be very quick. Like that thing can take your money very quick because it's very fast. So this is where sniper entries come in and everything. So guys, now the recommended leverage by me is 1 is to 500 to 1 is to 1000, because I wouldn't want you to trade 1 is to 2000 or 1 is to 100 now, or those things, while you are still a beginner. This would be perfect for you. Minimum funding, I would recommend you funding 1k above, you see, 1k above. But first guys, start with a demo account, familiarize yourself with the market, and then get into it. Let's go to the next point. So guys, now we are at trends. We are at your uptrends and your downtrends. So how do we identify trends? Trends is identified by higher highs, higher lows, higher highs, and higher lows. What's a higher high? A higher high is when the market comes to its highest point, and that's when it creates its higher high. When it comes to its lowest point, that's where it creates its lower low. It's higher low. But you see, the higher low does not break the lowest low. That's why we identify it as a higher low, you see. But a higher low cannot be identified till the next higher high is being created. That's when you get your higher low, you see. So the higher low is basically when it doesn't break the lowest low, and the higher high is when it breaks this high and creates a new high in the market. This is a higher high, lower low. This is how you identify an uptrend. So just by connecting your lows and your highs, you'll now be able to have like a trend and a channel and all that. Downtrend is the same thing. It's just in a downtrend you have lower highs and lower lows and lower highs and lower lows. Let me talk about the lower high. So the lower high is the high that's lower than the previous high. We identify that as our lower high. And then our lower low, our lower low is the low that's lowest than the previous low. So guys, it's in the name. Lower low, lower high, higher low. It's in the, come on guys. So guys, a trend, it's not that hard. A trend, you can use a trend to trade, but then you need other key like supporting components that will help you take the trade. You can't just take a trade on analyzing a trend line, like, okay, this is a trend line, first touch, second touch, third touch, and now you want to sell. Okay, it's fine, you sell on third touch, but what supplies the market on selling? Is there a supply? Is there resistance? There has to be something. A trend line is just there to guide you. So basically, if you're selling here, you're also selling against the trend. So you need to have a strong component this side that will support you to sell here. Understand what I'm saying? Let's go to the next point, guys. So guys, what is a currency pair? A currency pair is basically one currency versus another currency, like euro USD, the dollar versus euro. So guys, it's all about you knowing that one currency versus another. So it's like USD or the dollar versus now the rands, dollar versus the rand, so it's USD ZAR. You see, so a currency pair is basically two currencies put like against each other, and then you just trade the rate of that currency. Let's say the rate of 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 the dollar is 16 now in Namibia. So which means that if you had to take $100 and bring it to Namibia, you'd multiply that by 16, which you will get 1,600, so once the dollar's rate increases to 17 against Namibia, when you come with $100, you will now be able to get 1,700 Namibian dollars, which means that the rate of the US dollar went up, which means USD, let's say if there was a pair like USD NAD, like USD Namibian dollar, we would be buying that. You see, so how do currency pairs work? It is in the name forex, which stands for foreign exchange markets. The USD is a strong currency than the ZAR by 16. So that's now the rate 16. If the USD loses value, USD ZAR will be selling, and if it gains, USD ZAR will be buying. Simple. So guys, USD ZAR, it's like USD versus the rands. So if USD gains, when the economy of USD goes up, it means that USD ZAR would be buying, and if the economy of the dollar has to decrease, it means USD ZAR will be selling, because USD is the base currency. It's the first currency, it's the primary currency, in the currency pair. USD ZAR, USD CAD, USD JPY. But if we now there are things like Euro USD, there are things like GBP USD, where now GBP is now the secondary currency. It's not the first currency, so if there's a USD event, these pairs could still be traded like GBP USD. Let's say the USD event came out positive, which means that GBP USD is gonna sell, because GBP USD is the primary and it has to be performing strong in order for that currency pair to buy. So guys, now we're gonna be talking about a pip. What is a pip? A pip is the smallest number that moves in a currency pair. Guys, this thing, it's so simple. You see this number here that I've recorded, 16.000. So the pip, let me say it's these two numbers. This is like this is a pip, the first number, and then this 2 is like, we could record it as 10 pips, and then this one, it's 100 pips. So guys, a pip, it's something that, when the market moves up, if the price moves up by this one decimal, you would say that the price moved up by a pip, or so that's it, guys. It's not a lot, guys. It's not a lot. Let's move. What is a stop loss? So guys, a stop loss is a limit you set to minimize your loss at a certain price, so a stop loss is a limit you set to minimize your loss at a certain price. So once you have entered a buy, or once you have entered a sell, then you set, let's say you have entered a sell. Let's use this example as a sell. So once you have entered a sell on the market, and then you set this thing called a stop loss limit, like on top of the entry, like you have entered a sell, right? So it's on top of the entry. When the market triggers that stop loss, it means that you will like go out with a specific amount, rather than losing your whole capital. You would be able to take 3 trades and then lose your capital if all those trades go against you, or would you want to lose your trades at once? You see, so it's all about the risk management, guys. I'll drop a video on risk management. I'll drop a video on how to use MetaTrader 4. I'll drop a video on how to use all these things, but first we have to hit 100 subscribers, guys. So guys, let's continue. What is a take profit? A take profit is a limit you set to stop your profit at a certain price, or let's say to take your profit at a certain price. So let's say you sell again, let's say you sell, so the take profit is the one that you'll put under. Now you'll put it under the trade, and maybe when the market hits that take profit, the market will stop you out there with the, let's say, 300 rands profit. You see, you could have gone more than that, or you could have like made less than that, but then the take profit and the stop loss, it's there to use like your proper risk management. It's there to manage your money. Maybe you're a busy person, you use things like stop loss, take profit, buy limit, sell limit, all these things. What is buying and what is selling? When you click the buy button, you are trading the market to the upside, and when you click the sell button, you are trading the market to the downside. So guys, when you trade, you always see buy, sell. Understand what I'm saying? You see buy and sell. When you click the buy, obviously you want the market to go up. When you click the sell, you want the market to come down. It's easy. So guys, we have come to the end of our video explaining what is forex and explaining the small details of forex. If you guys want more of this, just catch me on another video. Yeah, sharp guys.